So I did a video a few months ago talking about how I got a HELOC or a home equity line of credit on one of the first investment properties I bought almost 4 years ago. And since I did that video, I actually had a number of viewers reach out to me directly and kind of just ask me about more details and more information about this kind of strategy and how they can use it. So I thought I would make a follow-up video and talk more about the HELOC, right? Specifically on the rental property, and talk about how you can actually get this kind of property, why banks are viewing a home equity line of credit on investment property versus an owner-occupied property differently, and what other considerations you need to account for if you're thinking about using this strategy either as a financial tool or to continue to grow your portfolio or whatever it is. Before I get into that, really quickly, first, my name's Lior and I'm a real estate investor out of Boston. And if this is your first time on this channel, smash that subscribe button for me. I put out tons of videos every single week talking about different facets of real estate investing, different tools, metrics, strategies, whatever. So if you haven't subscribed to my channel, make sure you smash that button. So first I thought I could talk a little bit more about what actually a HELOC or a home equity line of credit is, right? Because I know I throw this term around a lot and a lot of people do as well, but I don't think everyone truly understands what it actually is, right? So a HELOC or a home equity line of credit is simply a line of credit, right? You may have heard this in other products. I know banks always send me mailers for like business lines of credit. I've had offerings for other types of secured lines of credit, right? And all that means is that credit that you receive is backed by some sort of collateral. Some banks will even offer unsecured lines of credit. Those are certainly tougher to get because you're basically not putting up any collateral behind that money you're borrowing. So those are a little rarer and that's a different topic, but you probably have heard this concept of getting lines of credit with some sort of collateral. And a HELOC is literally the same exact thing, except basically your collateral is your equity in a house, right? So that house could be your personal residence or an owner-occupied home. Let's say it's a single family or condo, whatever it is. Or that house could be an investment property, right? Like a rental property that you rent out, maybe a condo, 2-family, 3-family. So basically what would happen if, let's say you defaulted, right? Let's say you borrowed that money and you weren't able to repay it back. The bank's protection is they could go after that property that you put up as collateral. So whether it's your personal home or investment property, and go after that property, and the bank knows that you've got a certain amount of equity in that property where they can recoup their investment that they lent to you. One other distinction I'll make about a HELOC is it's not exactly the same as doing something like a cash out refinance, right? Because on a cash out refinance, you literally leave closing table with a check, it's cash, you can put it in your account, boom, you're done. A HELOC is literally a line of credit. So what happens is when I opened mine, I literally got an account that says, hey, Lior, you can take out up to $40,000 of cash, right? So it is, you can still take that out, and you can take that out as checks. You can write out checks based on this account. You can wire money, whatever it is. But it's not necessarily cash going into your account the day of closing. That's the only difference, right? And the other thing, of course, is with HELOCs, it is a line of credit. There is an interest rate associated with it, right? So I do pay a certain amount of interest every single month based on the amount of money that I borrow. But the end goal is the same. At the end of the day, it's still money you can use. So whether you're gonna go use that money to go buy a boat, which I personally would not recommend, or you're gonna use that money for some sort of financial gain, maybe go buy another rental property, invest in stocks, invest in a business opportunity, whatever it is, right? You can still count that as somewhat cash, use that money and go invest in it and do whatever it is you need to do. Now, that being said, let's talk a little bit more in depth about why there's a difference between getting a HELOC on an owner-occupied property versus a HELOC on an investment property. And the clearest way and probably the easiest way of thinking about this is, think about this example, right? Let's say Joe has a house and he's gonna take a home equity line of credit on it, right? And let's say he takes that line of credit and a couple of months later, he runs into some financial distress, right? Whether it's the market, maybe his business is not doing well, his rental property is not doing well, or whatever it is, right? Some sort of financial distress hits Joe, and Joe's not able to make his payments on the home equity line of credit. So the bank is gonna go after Joe and whatever that property is that he put up as collateral. Now, think about this. What do you think Joe has more incentive to save if he put up collateral as his personal residence where he lives, maybe has his family there, his kids there, or if he put up an investment property where his tenants live and pay him rent? Most banks would say, you know what, Joe's gonna work a lot harder to try and save his personal residence because that's where his life is, right? Whereas an investment property, yes, it's a property you still own, but if you lose it, it's not like your family gets kicked out in the street. So that's why banks typically like to favor HELOCs based on primary residences, right? Because the borrower is much more likely to really fight and try to do whatever it takes if he runs into distress to pay off the bank so that they don't take over his home. So that's why typically lenders will give you higher loan to value or LTV if you take a HELOC out on a personal residence versus an investment property. And that's why most lenders are also way hungrier to do a HELOC on a personal residence than an investment property, because it's just overall a riskier type of financial product for a bank to give that HELOC on an investment property. So let's put some numbers behind this. Your average bank, if you walk into any bank around your corner, it could be a Bank of America, it could be a Chase, it could be a local community bank. Most of those lenders will do a home equity line of credit secured by your primary residence, and they will go up to 75%. I've even seen offers up to 80% loan to value. And just to give you guys a little bit clarity what that means, let's put some numbers behind this. Let's say you've got $1 million house and your current mortgage on it is $500,000, right? So you're at 50% LTV. Basically, if that was your personal residence, you could try to go to a bank and ask for a line of credit up to $300,000, which would be 30%, because that would take you up to an all-in value of 80% loan to value. So with personal residences, the banks will go up to 75 to 80%, but what about an investment property? Well, most lenders that I've talked to really do not want to go much higher than between 60 to 70%. And you really have to work really, really hard to try and get 70%. And even way harder to even try to get that 75% loan to value. Now, if you're gonna go after this path of trying to get a home equity line based on an investment property, my suggestion is you don't actually go to your bigger banks like your Bank of America, like your Chase, or any sort of large bank. My suggestion is you actually try to go to a local community lender. And here's why. Because if you're gonna ask for a home equity line of credit on an investment property, again, we've already established that's a riskier loan. So if you go to someone that's local, close to that property, operates in that market, that bank and that lender is much more likely to be comfortable with the idea of lending on that property, right? Because they probably know that market in and out. They probably do loans in that market all day long, right? So if you go into them and pitch them, hey, I've got a property, it's maybe a mile away from you guys. Like I'm sure you guys know all about this market, the rents that I'm getting, etc., right? They are much more likely to be comfortable with the idea of issuing a loan instead of someone, a national bank or maybe a bigger bank that doesn't really have local operations, right? Because again, that local community bank is really active in that market. They probably know that market in and out and can probably be convinced to try and loan on that product when they know it super, super well. Now, again, you're still gonna have to work really hard. You're still gonna have to talk to a ton of lenders because it is not an easy pitch. So when I was going through this process, I probably talked to like 10 or 15 banks before I found the right bank that I thought would be most comfortable with issuing this kind of loan on an investment property. But if you're able to go through it, if you do the homework, and if you go have these conversations, I bet that you can find a local community lender to get comfortable with the idea of issuing you a HELOC on an investment property if it's within their own local market. So now that we've established all of this, let's talk about lastly about the actual process of how you're gonna go about to get this HELOC. Once you find a bank or a lender that's gonna issue this loan, the process is pretty similar to getting a mortgage, right? You're basically gonna have to submit all your financials. So you're gonna submit all your income, your W-2 pay stubs, whatever, your 1099s if you're a 1099. They're gonna go through all your debt, look at your complete financial history, probably ask you for 2 years of tax returns, obviously look at your credit scores. They're gonna also really evaluate that property in question, the investment property in question, and they're gonna ask you for leases, if it's a multifamily or just a lease, if it's a condo, They're of course going to order an appraisal and really try to get a third-party validation about what that property is worth to really confirm the amount of equity that you think you may have in that property. So all of those things are pretty typical along the mortgage/loan process, right? If you're gonna buy a home or refinance a home, you're probably gonna do you're definitely gonna have to actually submit that same exact financials and paperwork. So it's very similar to those, getting a HELOC is very similar to actually buying or refinancing. You're gonna have to go through all those steps. And at the end of the day, if everything goes through and the lender feels comfortable with the amount of equity you have, the appraised value, and the amount of and the amount of money that you're actually asking for, they will at the end of the day issue you that line of credit. So I know that was a lot of details, so hopefully that makes sense, guys. I mean, like I said in the intro, HELOCs, a great tool, right? It's one of the many reasons why I love investment property, because you can figure out a way to continue to leverage each and one of your properties to continue to expand your financial portfolio, your real estate portfolio, your business portfolio, whatever it is you're looking to do with that HELOC. So it's an amazing, amazing tool. So if you guys have any questions, any thoughts, shoot them below and I will help you out.